Good morning, I am Malik. Welcome to the War Room. Today is Wednesday, March 11th, and if you watched the tape yesterday, you witnessed one of the most violent, psychotic trading sessions in the history of the Pakistan Stock Exchange. On Monday, we suffered an 11,000-point doomsday liquidation. But yesterday, the machines flipped. The KSE-100 index violently reversed, exploding upward by a staggering 9,696 points to close at 156,177. At one point during the session, the index actually spiked as high as 158,354 before pulling back. We saw over 486 million shares traded on the main board. Retail traders are suffering from severe whiplash. The timelines are flooded with people declaring that the bottom is in. They believe the 11,000-point crash was a fluke and that the V-shaped recovery has officially begun. Before you deploy your hard-earned capital into this chaos at the opening bell, I need you to listen to me very carefully. This is not an organic recovery. This is a phantom squeeze. Today, we are going to dissect the anatomy of this 9,700-point green candle, and I will show you exactly where the trapdoors are hidden. Let us break down the pure tape mechanics of yesterday's nearly 10,000-point surge. How does a market recover 6.62% in a single day while the global macro environment is still completely paralyzed? It comes down to order book dynamics and short covering panic. After Monday's historic liquidation washed out all the leveraged retail capital, the order book was completely empty. There were no natural sellers left at 146,000. When the state-backed institutional funds stepped in yesterday morning to accumulate heavily discounted blue chips, their buy orders hit a vacuum. Simultaneously, the rogue brokers and institutional short sellers who made millions during Monday's crash realized the state was buying. They panicked. To lock in their profits, they had to frantically buy back shares to cover their short positions. That forced algorithmic buying against an empty order book is what caused the index to gap up 9,700 points. Look outside your screens. The Gulf is still burning. The western border is still locked down. The IMF review mission has not signed a deal. The macroeconomic rot has not been cured overnight. Yesterday was a mechanical short squeeze, and if you chase it today, you are walking blindly into a slaughterhouse. Listen to me carefully. I am telling you to stay in cash. I am telling you not to buy this 9,700-point bounce. And I know some of you are asking, Malik, if the market is going up, why shouldn't I buy back in? Let me explain exactly how the smart money hunts you. Imagine you are a foreign institutional fund. You own 50 million shares of a major energy company. When the market crashed 11,000 points on Monday, you wanted to sell. You wanted to take your money and leave the country. But you couldn't. Why? Because the order book was empty. Retail was wiped out. If you tried to dump 50 million shares on Monday, the price would have instantly gone to zero. Institutions cannot sell in a crash. They need liquidity. They need buyers. So what happens? The state engineers a massive 9,700-point short squeeze. The screens turn bright green. Financial Twitter explodes with people saying the bottom is in. Retail traders feel the FOMO, the fear of missing out. You take your hard-earned cash and you blindly hit the buy button because you think the market is going back to 160,000. The exact second you hit buy, that foreign institution is waiting on the other side of the trade. They hand you their depreciating, high-risk shares and they take your cash. You are not participating in a recovery. You are financing an institutional escape. You are literally providing the exit door for the smart money to leave the battlefield. Until the macroeconomic rot is cured, until the Gulf stops burning and the western border opens, every single green candle you see is just an institution creating fake demand so they can dump their heavyweights. If you buy back in today, you will be left holding the bag in a market with no floor. Despite the macroeconomic whiplash, the corporate boardrooms are still active. Today, Wednesday, March 11th, we have two critical meetings that the smart money is watching like hawks. Keep your screens locked on these exact times. 09 a.m. LSE Capital Limited. They are holding an early morning mystery meeting in Lahore to consider matters other than financials. Let me be perfectly clear. When a major capital and financial holding entity calls an emergency non-financial meeting right in the middle of a historic market crash and recovery cycle, it signals emergency risk mitigation or a massive structural pivot. Watch the early tape closely. 03 p.m. Century Insurance Company Limited. They are dropping their annual accounts this afternoon in Karachi. In a wartime economy with global shipping paralyzed, insurance risk premiums have skyrocketed. We will be dissecting these numbers to measure the exact exposure and survival margins of the insurance board. Here is your battle plan for Wednesday. 1. Respect the volatility vacuum. We are operating in an environment where the index can swing 10,000 points in either direction purely on algorithmic momentum. Support and resistance levels are currently an illusion. Do not trust the charts. 2. The exit liquidity trap. If the market opens green today and tries to push past 157,000, do not chase the gap. The institutions that rode the 9,700-point bounce yesterday will likely use today's morning optimism to dump their heavyweights onto greedy retail traders. Do not become their exit liquidity. 3. Cash is your shield. The safest position during a macro liquidation and short squeeze cycle is cash. Let the algorithms bleed each other out. Your only objective today is to survive the whiplash. I am Malik. We trade the mechanics, we respect the macro, and we never trade on hope. Protect your capital. Survive the Wednesday. Disclaimer: StockSense is an educational platform. I am an analyst, not a financial advisor. The market is facing unprecedented geopolitical volatility. Trade at your own risk.